Let's bring in BTIG's Jonathan Krinsky for more. Jonathan, markets, you just heard me mention, some of the NASDAQ big names, the ones that kind of matter, they are higher. We saw VIX that hit 60 briefly, massive volume at the open. Do you think we're at capitulation?
Hey, Brian. So, when you look at all the major bottoms over the last 40 years or so, we're seeing signs that are consistent with a lot of those bottoms. Now, when you get into this type of volatility, and as you've seen today with a 9% intraday range on the S&P futures as of now, calling the exact bottom is very difficult. But we think we are in the ballpark. And you mentioned that 200-week moving average, which we don't talk about that a lot because, quite frankly, you don't get near it very often. But in times of extreme market duress, it tends to be a good market barometer for a trading low outside of recessionary bear markets, deep recessionary bear markets. So if we look at the last 40 years, the only two times when the 200-week moving average has been violated for a meaningful amount of time was the 2002 bear market and the great financial crisis in 08-09. Even the crash of 87, the EU crisis in 2011, they all stopped at the 200-week moving average. And that comes in around 46.75. We got within about 3% of that overnight in the futures. So, yeah, we think we're in the ballpark here.
Yeah, and I don't want to be the Grim Reaper up here, okay? I've been doing this 30 years as well, and ultimately all crashes, while painful, turned out to be longer-term buying opportunities. But they could be very long because if you go down 20%, you got to go up 27% or whatever the number is to get back to where you were. It's just the law of math. Does the speed of the decline, though, Jonathan, does that matter in your analysis? And here's why I ask. In 2022, 3 years ago, the markets fell 25% top to bottom, but they did it slowly. January to October was like a slow bleed. It was a terrible year overall. This is losing 20% in a matter of days. Does that speed and violence go into your thinking and your analysis?
Yeah, so there often is symmetry in declines and rebounds. Again, think about the crash of 87. It was severe and swift, but you rebounded quite quickly. The COVID crash, similarly, extreme downside move, and then you V-shaped back to the highs. And conversely, like you said, 2022, you think about some of the more long, dragged-out bear markets, they can take longer to recover. So in some ways, the extreme downside velocity does lend itself to a potential V-shaped recovery. We're not calling for that yet, but I think that's certainly in the cards. And you do tend to see that symmetry often in markets.
All right, so let's go back now to the very patient Jonathan Krinsky. Jonathan, thank you. On Friday, not today, home builders are down today, but on Friday, they were the only sector of the market that was higher. What's your technical take on the home builders or anything real estate related vis-a-vis interest rates?
Yeah, so sometimes when you're going through a bottoming process, and again, we don't know if this is the bottom, but in a bottoming process, you get the parts of the market that were first into the bear market and the hardest hit are the ones that perform the best initially coming off the bottom. And I think home builders was clearly one of those sectors. Conversely, on the other side of the coin, at the tail end of the correction, you finally get the areas of the market that have held up the best. And that is the low volatility, the defensive names. Think of your consumer staples, your utilities. So those actually got hit the hardest on Friday. And we think there's still some risk to those groups in either direction, right? If you get a rebound in the market, a risk rebound, those defensive sectors are going to lag, and those hardest hit groups like the home builders, maybe some tech names or some consumer names likely get the biggest rebound initially off the bottom.
I want to ask you one question about volume and this data. I'm going to sound smart because I've got Gina and Chris and everybody on the data team behind us here at CNBC doing the heavy lifting for me. We're seeing 18.5 billion shares traded already. That's more than the 10-day moving average of 60 for the whole day. By the way, we've already surpassed by 2 billion the average daily volume, and we still have 2.5 hours left to go. And on Friday, we had the highest volume day going back to the financial crisis of 2007. What, if anything, Jonathan, does that type of volume tell you about the market?
It's volume is really just a function of the volatility. I mean, you can't really have a market, sell off or crash or whatever you want to call this without an increase in volume. It almost always happens, at least on the index level. So I think that's telling. It's part of the capitulatory, some of the capitulatory signals you're seeing, along with the inverted VIX curve, starting to see some elevated put call ratios, just different sentiment measures. So it's consistent with that capitulation. And yeah, today should be a record for a lot of different volume metrics.